Welcome back to Book Club. Before I jump into the actual book, I just want to talk about my trading day today. I did some pretty reckless shit today. I ended up losing like $295 in the market, making some fairly responsible trades, and I was watching the market just fall all day, and then finally at the end of the day, after I had a loss, I kind of just decided, like, I felt like I saw the perfect trade opportunity. I jumped into it. I jumped in trading with 50% of my account. I went into like negative 700 at one point in the trade, and that's just not good risk management. Anyway, luckily the entry was decent enough for me to actually win the trade, and I ended up coming out on top. I made the money back that I lost in the market, plus just a little bit more. But man, that was fucking crazy. I almost fucked my whole shit up. And one thing that I've noticed is that, unfortunately, like, the market can, at least for me, the market and how I perform in it on a lot of days will kind of dictate my mood. And so if I trade poorly, then I just don't feel as good about the rest of life. And for me, it might be because of like my level of passion for it, but when I trade poorly, my attitude is not the best. But today, when I was down 295, this was one of the first times where, like, I was okay with the loss, and I didn't start revenge trading. I actually got out of the market instead of going deeper into it and just getting crazier and crazier. But I accepted the fact that I was at a loss. I was comfortable with that. And I actually stopped for like most of the day. I went to the vacation rental and I did, the stuff that I needed to do there, talk to some of the customers, whatever. And then I came back, but I felt like I saw the perfect pullback. And so I wanted to jump in it. The entry just wasn't that great, and I just got lucky. So I guess I just kind of want to remind people that, like, one of the best ways to just fare on a day-to-day basis, like emotionally and just in every way when it comes to being a trader, is just like have your rules, stick to them. And even if you have a red day, you can make the money back as long as you don't blow your entire account, right? Like we talked about the money in your account kind of being like, it's zombie apocalypse. You have one gun, one clip, and you only have so many bullets, and you really have to deploy them at the right time. And because if you don't, then you're definitely setting yourself up in the future for like massive failure. Like, you don't have any cushion whatsoever. When you're losing, your mindset, your mind state rather, is just different than when you're winning. You oftentimes will not make as good decisions. You can just more easily succumb to like the pitfalls of the market whenever you go outside of your strategy, and whenever you start doing dumb shit that just pile up your losses. Like, it's really hard to come back from that, even if just from like a mental, emotional place. Like, you really need to stay within your rules and parameters, and it's okay to have a red day. Like, it's okay to lose. I'm glad that I came back, and I still have a green day, and I'm still 4 days, like what would you say, 4 days in profit, or on a 4-day streak still, since I was able to come back. But I literally could have blown the whole fucking thing. Just a reminder, just respect your rules. Anyway, so we're gonna jump into the book. So we're on chapter 2, tapping into the wisdom of the crowd. We are on breaking normal. Figure 2-1 and 2-2 illustrate support and resistance as measurements of supply and demand that is developing in a normal way. Support and resistance become inaccurate when markets get excited about big news, a revolutionary discovery, or a geopolitical event. Demands get disrupted, sometimes irrationally, and prices soar or tank. This disruption is called a breakout, and you never know whether it will persist and become a lasting uptrend or downtrend, as the case may be. Breakouts are a clear warning sign that something happened to change the market sentiment toward the security and thus demand for it. Breakouts must always be respected, but beware, they're often false, meaning short-lived. No new trend emerges. The price slumps back into something resembling its former range, Only support and resistance are wider apart now to accommodate that one breakout. I discuss breakouts in greater detail in chapter 11, but remember the prices are reflecting human behavior and much of it is emotional, like the eBay bidder. Here's the hard part to swallow. Even the most sedate of price trends will deliver a breakout once in a while. The breakout can be caused by something as simple as a rumor that turns out not to be true, or some big players deciding to unload some inventory in order to buy something more interesting. When an oddball price move comes along and you can't identify the trigger for it, you might be forgetting another supply and demand factor, the financial condition of the rest of the crowd. This is named positioning, and it can be a powerful factor that moves prices substantially and seemingly without a reason. There is a reason, but it's confidential information kept secret by the big players. Each of the big players in every market has a position limit dictated by top management. For example, the guy in charge of high-tech stocks at your pension fund can invest no more than $500 million in that sector at any one time. Say the high-tech names have rallied substantially and now his position is $600 million. He has to sell $100 million no matter what the chart or guru say about likely gains still to come. Position squaring is the closing of positions. Position squaring doesn't necessarily imply that the market participants think that the move is over. They may plan to re-enter the security in the same direction later on. Position squaring occurs for many reasons, including the following. Traders think that the move is exhausted for the moment. Traders have met a price objective, whether profit or loss. Traders have met a time limit, such as the end of the day, week, or tax period, week, month, or tax period. Traders want to withdraw money from the security to trade a different security for a non-trading purpose. Position squaring occurs when a large number of traders have big losses too. Say, for example, a high percentage of traders believe in a particular price move scenario that then fails to develop in the expected way. A few traders throw in the towel. The resulting lowering of the price may cause bigger losses for the remaining traders, and they in turn give up. You get a cascade of stop loss orders being hit that turns into a down market route or even a panic. A stop loss order is an order you give your broker to sell your position if it goes against you too far and reaches the maximum loss you're prepared to accept. We talk about stop loss orders more in chapter 5. Going against the grain, retracements. Repositioning by big players, whether they want to or not, can sometimes be the secret reason you'll get retracements, defined as minor movements in the opposite direction of a trend. Retracements can also occur because a majority of players just think a price move has gone too far. For either reason, price seldom moves in one direction for long. A retracement is also called a correction, which explicitly recognizes that the security has gone too far and is now correcting course like a ship. A retracement may also be termed a pullback or throwback. Retracements don't really come out of the blue. Usually a retracement is a function of a trader seeing too much of a one-way street. All buyers and no sellers, or the other way around. When a position is crowded, at some point prices just stop moving. There is no fresh news to change the market sentiment, just a kind of temporary exhaustion. Sometimes the price just stops and hovers in narrow range around a particular level, but just as often the price moves into the opposite direction for a while as traders take profit or cut losses, as the case may be. Recognizing why retracements happen. When the market runs out of cash, traders have to close positions to get their cash back so they can put in new trades. If they've been buyers, they need to sell. If they've been sellers shorting the security, they need to buy. Therefore, at the extreme outcome or outside limit of a price move, you should expect a temporary minor reversal of the previous price move. In an uptrend, a retracement is always a drop in price. In a downtrend, a retracement is always a rise in price. You can sometimes see a retracement coming. When a price has reached or surpassed a normal limit defined by support and resistance or an indicator, that price is at an extreme. In an up move, everyone who wants to buy has already bought. In this case, you can say that the market is overbought, a term specific to securities trading or extended. In a down move, when everyone who wanted to sell has already sold, the security is called oversold. Several indicators help identify extended positions, including something frighteningly named a stochastic oscillator, which I discuss more in chapter 13. Notice that the terms overbought and oversold are applied to the security, but what the terms secretly refer to is how much money the traders in that security have available at the moment. By the time most of the market participants have jumped on the bandwagon, they are tapping out. All their money is in one position. Traders have to exit their positions just to get their cash or credit to conduct additional trades. One excellent way to detect an extended position, an imminent correction, is volume. This is logical. When you get more traders crowding into a position, rising volume, but hardly any price increase, the move is ending. Using fundamentals to gauge retracements. Retracements can get out of hand and transform themselves into trend reversals too. At the time a retracement starts, you don't know for sure that it's a retracement. For all you know, it could be a full reversal with the price switching direction. In this situation, you do well to check the fundamentals, the news, the events pertaining to the security. An ordinary retracement caused by normal position squaring can suddenly turn into a full-fledged route in the opposite direction. If fresh news comes out that seems to support a reversal, Figure 2-3 shows a primary trend with several retracements, each outlined by an ellipse. In this instance, the retracement lasts only a day or two, but retracements can last a lot longer, even several weeks on a daily chart, for example, of the retracement. Okay. The press often asserts that every retracement is a profit-taking correction. This assumption isn't accurate. If traders took profit on every correction, they'd all be rich. Remember, somebody bought at the high. If the correction goes too far against him, he must get out of the position at a loss. From this observation, you should deduce that to stick to a position when it is correcting against you requires the courage of your convictions and capital. We talk more about managing money during retracements in Chapter 5. Catching a falling knife, estimating where and when a retracement will stop. To try to estimate where a retracement will stop is called to catch a falling knife. In other words, no reliable rule exists to tell you where a trend correction will end or when the primary trend will resume, or even that it will resume. One of the chief uses of indicators and combined indicators described in Chapter 16 is to get guidance on whether and when a retracement will stop. Remember that the indicators only indicate, they don't dictate. Your tolerance for retracements is the key to deciding in what time frame you want to trade. If the security you want to trade regularly retraces 50%, the prospect of losing 51% turns you into a nervous wreck. You need to trade it in a different time frame or find another security. Acknowledging that no one can forecast a retracement hasn't stopped technical traders from trying to establish forecast rules. The following rules are generally helpful, but no one can offer reliable statistics to back them up, so take them with a grain of salt. Look for the previous, really take it with a grain of salt. Look for the previous significant high or low. Figure 2-3, for example, the second retracement doesn't challenge the lowest low of the first dip, and the third retracement doesn't challenge the second. Alas, knowing where it won't go doesn't help you figure out where it will go. Number 2, look for round numbers. Research shows that support and resistance levels actually do occur more often at round numbers than chance would allow. Remember the 30% rule. Measure the percentage change and assume that a majority of traders will place stops to avoid losing more than X percent, such as 30%. The problem with this idea, and it's a chilling one, is that you're measuring from a peak. You don't know the price level where the majority of traders entered. Logically, you should assume that they're protecting 70% of their personal cash gain from their entry, not from the peak. To measure from the peak would be to say that traders make decisions based on opportunity loss rather than cash loss. And although this contains a germ of truth, it's not a reliable assumption about crowd behavior. And lastly, use magic numbers. Oh man, it just sounds bad. Magic numbers. I mean, I'm not more of an expert than this book, but I'm just saying it doesn't sound good. Some traders believe that retracements always end at a specific ratio to the preceding move, such as 38% or 62%. Okay, so they're actually talking more about like Fibonacci here. I cover this in Chapter 17. Yep. All right. Breakouts and retracements each occur in sedate normal trends, as well as more choppy price moves. A great many breakouts are false, meaning they seem to signal a pending change in direction, but they're in reality just exceptionally loud noise. Similarly, a great many retracements are just normal adjustments to changes in supply and demand conditions. All securities exhibit both breakouts and retracements. You can't avoid them. One of the biggest challenges in technical trading is figuring out how to cope with breakouts and retracements by using indicators carefully. Okay, so we're gonna stop right there, and tomorrow we'll read Accepting When the Crowd is Extreme. Thanks for joining for book club today, and when we come back, we'll talk about Accepting When the Crowd is Extreme. And again, I just want to remind you to stick to your rules. Whatever your rules are right now, just stick to them. You developed them for a reason, so respect them, adhere to them, and don't fuck around, all right? Because if you're anything like me, whatever your performance is in the market is gonna dictate how you're feeling, honestly, just generally in life. It's a very big deal to me. The development of my trading skills is everything to me right now. So if I don't perform well, I don't feel well. It's Friday. Everybody's outside and everybody is doing whatever they're doing, and my brain is just I'm on it. I'm obsessed. I will see you next time. Thank you for joining the book club vlog today. Remember to follow your rules. Get some good rest this evening, if this is evening for you, and we'll be back at it tomorrow. All right, peace, guys.